Hello guys, Assalamualaikum warahmatullahi wabarakatuh. Um, nice to meet you. I'm Nofri Suhardianto, your instructor, your lecturer in this Introduction to Accounting 1, and we're gonna learn some very basic principles in accounting, and this is the part of Introduction to Accounting 1. Okay, are you ready? I suggest you to read the book, do the practice exercise before or after or during listening to this video. Okay, so let's get started. Okay, so we are going to discuss some very basic principles in Introduction to Accounting. We are going to discuss some basic concept about business and accounting. So to make it focus, I will turn off the video and to let you focus on the content of this presentation. Okay, let's get it on. Okay, let's start from very basic definition of accounting. What is accounting? So if we want to learn accounting, we have to know what is accounting. Accounting is a system to provide financial information of a business. So accounting is a system. Accounting is a system that produces financial information. We can identify three keywords here. First, system. In any system, in every system in the world, there are three elements. First, the input, and second, process, and the last is output. Any system has input, process, and output. The output of accounting is financial information. Financial information, that's the output of accounting. And this output is the next keyword, the second keyword, financial information. Accounting is about financial information. Accounting is not about your customer satisfaction, for examples. Although some criticism addressed to accounting say that accounting should consider more non-financial information, is fine, but accounting itself is more focused on the financial information. For examples, the profitability of the business, the ability to pay the liabilities to pay the debt of a business. So accounting is not about how satisfy your customer, whether your employee is happy with you or not. It's not about that. Accounting is about the financial condition, the financial position of a company. The third keyword is business. Accounting is about business. Accounting is about the organization. So we have to consider, we have to know that accounting is not about society, for examples. Accounting is not about some group of people, but accounting is about organization. Accounting is about formal organization. So we're gonna learn deeply on these three keywords during this presentation. So please make note that accounting is a system. Because accounting is a system, there will be input, process, and output. The output of accounting is financial information of a business. And what next? We have to know what is the process and what is the input of accounting. First, we have to know what is business. Business, a company, an organization. From the business itself, I mean from the business that a company do, we can we can identify three types of business. First, manufacturing business. Manufacturing business, they transform the raw materials into a finished good. They produce the finished good using the raw materials, like Coca-Cola that produce Coke, and then Samsung that produce electronic apparels, Nike that produce sport apparel, and so on. So their business is to buy some raw material and transform these raw materials into a finished good. The second type of business is merchandising. In Indonesia, it's very popular, Indomart, Alfamart, and Matahari. So these three companies are merchandising business. They buy the inventory and sell the goods, right? So their business is very simple: buy the inventory and sell it. And the last type of business is service business, like Garuda Indonesia, air transportation, Kereta Api Indonesia, the train transportation in Indonesia, Bank Mandiri is banking service. So in service industry or in service companies, they don't buy inventory, they pay the salary of their employee, and the employee do the service to the customer. Okay, these three companies has different business. They do different activities in their operation. They have different internal process. That's why they will have different activity. They will have, of course, they will produce different information because they do different activities. From the point of view of organization, we can separate or we can divide business into three based on the organization form. The first is proprietorship, or in Bahasa we call as perseorangan. Proprietorship, a company that owned by a single owner. For example, if your mother or if your parents have this business, very small shop in front of your home, it's kind of family business. So it's proprietorship, owned by a single family or owned by a single person. The second is partnership. Two or more owner join the capital together, they contribute the capital and run the business together. We call partnership. And the last is corporation. This is the biggest form of a business. So the owner is more than two, and they have share. They contribute money to the company, and the investor or the owner will have share as a proof that they own some capital in the corporation. Each form of organization will have different activity or will have different business activity. For example, in partnership, they share the income to all owners. But in proprietorship, the profit will go to the single owner. On the other hand, in corporation, the profit will not divide it to the investor unless they agree to divide the profit. So because this form has different legal requirements and they have different activity, so they will have different different information, they will have different activity, they will do different activity in their business, they will have different legal requirement. That's why they will have different accounting. Okay, because accounting is about business. So how the business work, how the business works, how the business how the form of the business will affect accounting. So after talking about business, let's talk about business stakeholder. Every single business, there will be stakeholders. Any party that needs information about the business, any party that want to know about the business, they have interest in the business. We can divide these stakeholders into two. The first is the internal stakeholder. These are the people who has position in the company or in a business, and they want, of course, they need information about the business. The owners of the business will always want to know about his business. The managers who take care of the business, he produces the information and he need to measure whether he's doing good or not. The external stakeholders, creditors, government. Creditors want to know whether the company or the business can pay the debt or not. Bank, for example, bank want to know whether the client or the debtor can pay its debt or not. Government, of course, government want to know whether the company can pay the tax or not, whether or how much profit the company earn, and how much tax that they can find from the business. So every single company has its stakeholders, and accounting, again, accounting, back to the definition, accounting will provide the stakeholders with information, what owners decide, what owners need, what managers need, creditors and government, they need information, and accounting will provide the information for them. Okay, let's have some reflective questions. If you were the owner of a business, do you need information about your business? Yes, of course. As an owner, you will need information. You need information about the performance of your business, whether the capital that you invest in that company grow or not. Right? If you were a banker, do you need information about the credit worthiness of your clients? Yes, of course. You want to know whether the client can pay the debt or not. So you will search this information, right? And accounting will provide this information. As a businessman, do you need financial information to make decisions? Yes. You can name it, you can give many examples. For example, if you want to make a decision about whether you hire more employee or not, you need information whether you can pay this new employee or not. If you want to buy some more inventory for your trading, for your merchandising business, of course you need to know whether you can pay the debt, you can pay the supplier, right? So if you need information from the business, then you need accounting. Again, if you need information from the business, means you need accounting, because accounting is a system that provides information about the business. So let's have some examples, the decision and the information that you need. So for examples, a decision to buy inventory is a common decision, is a daily decision. But to make this decision, you need to know whether you can pay or not. Once you have the product, then you need to sell the product. Then you will decide how much the price that you sell the product. Again, when you're pricing the product, then you need to know how much it costs, how much profit that you need, and any information to justify your profit. Means that you need accounting to supply you information about the cost of the product. Okay, if you want to pay salary or you want to hire more employee, means you need to know whether you can pay or not. If you want to expand your business, you want to open a new branch, or you want to develop a new plant, means you need to know how much capital that you need. You need to know the financial sources of your business. All information here are the output of accounting. So they are the output of accounting, because accounting will provide you information. Accounting is not about gossip. Accounting is not about analysis, judgment only. Accounting is about information, and the information must be reliable. Otherwise, the decision will mislead. Okay, again, what is accounting? It is a process to provide financial information of a business. So the output of accounting is financial information. And the financial information is prepared, is packed in a report we call as accounting report or financial report. Okay, so how to get this output? How do we get this output? Then we have to do the process, the accounting process. What is the thing that we have to process? We need the input of accounting is transaction. Please check the previous presentation or the previous slide. Accounting is about system. Because accounting is a system, transaction is the input of accounting. And this is the process, and this is the output. It's always like that. And now your turn. Open your book, read, find what is transaction. What is transaction? Transaction is an event that changes the financial position of a company. For example, if the company has like 1 million in cash, and when the company make a transaction, this 1 million cash or 1 million asset will change. That's a very simple example of transaction, but please check again your textbook to know what is transaction, okay, to have a clear understanding about the input of accounting. And what is accounting process? What is accounting process? You will learn accounting process during this course. What are the types of accounting information that accounting provide for the stakeholders? Please read the book and find the answer of these questions. Okay, this is your duty. This is your part to self-learning. So now let's turn to the process of counting. First, ask yourself what you need to run a business. What you need to run a business. I need information. Okay? And in accounting, this information is symbolized as account. So, account, in my understanding, is a unit of information. When you go to the gas station, right? Gas station, or in Bahasa we call as SPBU. In gas station, you can find many types of fuel. You can find premium, you can find Pertamax, you can find Pertalite, and any type of fuel. So in accounting is actually the same. I mean, we follow the same logic. Accounting provide information. What kind of information? Then we pack this information. We label the information using account. For example, how much resources that the company has. We call these resources, we label these resources as asset. How much liabilities that the company has to pay. So we call this information as payable or liabilities, and so on. Account. So check your book again, find the definition of account. What is account? Next, what information you need? The very general information that you need to evaluate your business is these 5 items. First, assets. You need to know how many resources that the company has. It's about asset. How many payable or liabilities that the company has to pay. It's about liabilities. How much capital that the owner invests in the company. It's about equity. How much money that you earn from your customer is sales. How much money that you spend for the production process, for the selling process. It's about expenses. All this information will be provided by accounting, and accounting provide the information under the label of assets, liabilities, equity, sales, and expenses. So how to get the information? You remember what is the input of accounting? The input of accounting is transaction. So start from the transaction. Analyze the transaction. How to analyze the transaction? Follow the math. Follow the principles of math. By using mathematical equation, we can process the transactions and do this accounting process. What is accounting cycle or accounting process? We will do all the process in accounting cycle, from analyzing and recording transaction, posting to ledger, and so on. We will do this accounting cycle during the semester. Okay, so from the beginning, the transaction is the starting point. Analyzing transaction is the starting point. After analyzing the transaction, you need to record the transaction. You need to summarize the transaction. We are not going to write a diary, or we're not going to write a novel about accounting. but we will summarize the information, I mean the transactions, the event, into a nice information that useful for decision making process. Okay. However, to make the information reliable, to assure that the information is relevant for decision making, the process should follow accounting standard. Here, in accounting, we have standard we call as generally accepted accounting principles. This is a set of standards that we have to follow to interpret, to analyze a transaction, to summarize or to record the transaction, and to do all the process of accounting in order to provide reliable and relevant information. The second and the most important is professional ethics. In doing the accounting process, we have to obey ethics. If the business suffer a loss, it's fine. Report the loss. Don't try to make the loss into profit. Then means that you commit a unethical practice. So by following the accounting standard and obeying this professional ethics, the accounting process will generate a reliable information, trustable information. Accounting is about trust because you provide information. Once you get the trust, then the decision will be beneficial. However, once the information is fake, then you lose the trust, and accounting is nothing without the trust. Accounting is a public goods. It provides information for the public. That's why accounting should be credible. That's why accounting should follow the accounting standard, should follow this professional ethics. Okay, so let's talk about the business. When running a business, you need resources, right? For examples, you need cash, right, to run the business. You need inventory as the goods that you want to sell. You need of course, sales equipment, the store, and so on. But how do we get this? Where do we get this from? Then the only sources is two. There are two sources to get these resources. First is the liabilities, the debt. You buy the inventory from the supplier, but you don't pay yet. You pay later. Means you get this inventory, but you have to record a liability or debt. Otherwise, you will use your own money. Then it's owner's equity. Owner's equity. Owner's equity, or the capital that provided by the owner. Accounting is about the resources of business, is about the liabilities of the business. Accounting is about the capital that provided by the owner of the business. We are not talking about the personal fund of the owner. We are not talking about the personal wealth of the owner. We are talking about the business. Once you have a business, then accounting will take care the capital that you invest in a business. Accounting will not take care your personal wealth, because accounting follows a very great principle we call as business entity. Again, I suggest you to do self-study, find what is business entity concept. In business entity concept, accounting is about the business, not about the owner. For example, once you invest like 1 million rupiah for a business, then accounting is about this 1 million. Accounting will not take care, will not care about the how much money that you have left in your bank account. No. Accounting is about the business. It's all about the business. It's not about the owner. Okay, what we have on the left side is the resources, and we call these resources as asset. And where do assets from? It's the assets. The assets come from two resources. The first is the liabilities. There is the sources of assets is two liabilities and equities, or the capital. Okay, as you can see here, we just form a mathematical equation. Assets, the resources that business need to use, are from liabilities or owner's equity. Okay, so we have this basic accounting equation. Assets of a business are from liabilities and owner's equity. And this is the equation that we use in accounting. It's very easy. How much the resources that the company has, then where do the resources come from? So if it come from, if the assets come from liabilities, then you have to report how much liabilities that you have. If the assets come from the owner's equity, then you have to note how much owner's equity that you have. Okay, so we have many assets. Assets is a group of resources. It's a label, as I said. It's a label of many resources that used by the company, because company use cash, inventories, supplies, land, building, and so on. Please check your book to find the definition of accounts, of these accounts. And as I said, accounts is a single unit of information. For example, cash. Cash is a single unit of information. It's about how much money that the company has. On the right hand side, there are two accounts, the sources of the company's wealth, liabilities and owner's equity. There are some type of liabilities. under the label of liabilities, there are many type of account, and the last is the owner's equity, the owner capital. We can expand this accounting equation by using math. So we can use math to do some mathematical game. For examples, if you buy merchandise or inventory but you pay later, so your inventory increase because you just bought it, but because you don't pay yet, then you have to record liabilities. I will pay later. Then the supplier send you the inventory, but you have to record liabilities. So you add asset and you add the liabilities as well. So when the asset increase, the liabilities will increase. One example of transaction. Next, when you pay your liabilities, so you spend some cash to pay liabilities, then the liabilities will go down, will decrease. The second set of transaction is between asset and owner's equity. When the owner invests some money to the business, then business now receives some money. And on the other hand, the business will record, okay, this money is from the owner. So balance. Or if the owner withdraws some money from the business, then the business spends some cash and the cash will go to the owners. In other words, the capital that owner invested is just decreasing. Okay, so we keep the equation balance. Okay, we keep the equation balance. The last type of transaction is within each categories. Within asset, there are possible a transaction that will increase asset and decrease in the same time. For example, you buy some merchandise inventory on cash, means you receive some inventory and you spend some cash. So the transaction will affect the balance of assets. And again, we can expand this into more detailed account. As I said, sales or revenue. When the company sells its inventory or sells its service to the customer, the company will earn revenue, and the revenue will increase the owner's equity. When the company, for example, pay salary for the employee or pay the electricity bill and so on, so the company spends some resources to create revenue, so the expenses will reduce the owner's equity. And the last is actually drawing. When the owner withdraw some of his money from the business, so drawing will reduce the owner's equity balance. So it's your turn now to open your book to do some practice exercise related to accounting equation. So you can pause the video, do the practice exercise, and make yourself happy by doing more exercise. So after doing all the exercise, and then we just recorded all the transactions happened during the year or during the period, then this is the expanded accounting equation. As you can see, we have asset, liabilities, and owner's equity. But in asset, we have three items or three accounts: cash, supplies, and land. And we have only one liability account. It is accounts payable. However, we have some owner's equity account. In owner's equity, we can see some very expanded account. You can see the capital of the owner, the drawing of the owner. Of course, the drawing will will deduct the equity. This is the fees earned, the revenue, and this all the expenses of the business. So, as I said, the definition of accounting is to provide financial information. However, we cannot give this information of this form, this report to the company, to the business, or to the stakeholders. The investor will not understand what do you mean with this, right? This become very raw information. We have to process the information. So after recording the transaction, then we need to report. Okay, so after analyzing the transaction, after recording the transaction, then we have to report the information. We have to report the information that stakeholders need. So how to report? Then we have to provide financial statement. We have 4 financial statements: income statement, statement of changes in equity, or sometimes called statement of owner's equity, balance sheet, or sometimes we call as statement of financial position, and the last statement of cash flow. So how to arrange the previous data? That's very raw data. We can arrange the information into 4 statements. The first is the income statement. In the income statement, we report 2 things, or maybe 3 things. First, the revenue. Okay, the revenue, this fees earned, the revenue that earned by the business during the period. The expenses that the business spent to create or to achieve the sales or to achieve the revenue. And the net profit that the business earned during the period. And this net income or the net profit, okay, is carried to the second statement that called statement of owner's equity. Okay, so the second financial statement is statement of owner's equity. In here, in this report, we report very simple thing actually. First is the beginning balance of capital. So we report capital or equity at the beginning balance, and you add some profit. because the owners draw or withdraw some money, of course we have to reduce the capital or to deduct the capital by some withdrawals. Then we get this the ending balance of capital. Then we bring this ending balance of capital to the third report, that is balance sheet. In balance sheet, we can see our accounting equation, assets, liabilities, and owner's equity. These are the resources that the company has at point November 30. And this is the liabilities that the company has on November 30, and the ending balance of capital from the statement of owner's equity. So we report this at the balance sheet. On the balance sheet. And if you can see this cash balance, there is a report that tells the information about the cash that you have and the transactions and other information related the use of the cash, and we call as statement of cash flow. I will just show this statement of cash flow. Actually, statement of cash flow show you the detail about the usage of cash. However, we will not learn this statement of cash flow this semester for the introduction to accounting 1. You will learn the statement of cash flow in introduction to accounting 2 next semester. Okay, I think that's all that I can summarize the chapter for you during this video presentation, and I hope you can enjoy studying. I suggest you very hard to do the self-study. Without self-study, it's very difficult during this pandemic, this season or this time. So self-evaluation, self-study is very important for you. After watching this video, do some more practice exercise. If you cannot do by yourself, ask friend or ask me. You can ask help from me. If you want to know, if you want to send a message, just send a message or send an email to me. So I will let you do practice exercise, and we're gonna meet online after this. Okay, thank you and see you later.